Hey, welcome back. This is Mr. Market. Thank you so much for joining me. We are now into lucky episode 13. Let's talk about the market. Last week, the market recovered about a third of its losses, up about 1.5%. And for us, we ended up doing really well. As I mentioned last week, we had some pretty high options premiums from the higher volatility, and that as long as the market went up, we would be able to recover our losses. And that we did. Instead of recovering just a third of our losses, we ended up recovering all of our losses and more. We ended up recovering about 200% of our losses. We were up $3,355 for last week, and that put us up for the year to $17,759, which put us about 35% of our annual target. Remember, our goal is to earn about $50,000 or about 20% a year off a $250,000 portfolio. And we have a little bit more than 9 months to go, so we're doing really well. One thing that I started to look at was the up capture ratio, which was the percentage of the market's gains that we tend to participate in whenever the markets are up. Last week I did that analysis, and we tended to capture about half of the market's moves whenever it was up. So our up capture ratio was 0.51. For this week, our up capture ratio was 1.12, which was the highest that we've ever had. And given the low risk metrics that the portfolio has had, I kind of realized that I could take on a little bit more risk, and so that I did. Last week, we had our levels up at 375 and 370 on SPY. And as the market started to rise, I added more layers at 380 and 385. So part of the reason that we were able to recover so much of our losses from last week and generate such a nice profit is because the market is really scared right now. The Volatility Index, the VIX, is quite elevated. And whenever we have a high VIX, that usually means we get higher options premiums. So, in this case, high VIX equals high fear. High fear equals higher profitability potential. And we were able to go capture that. For this upcoming week with the Federal Reserve, these VIX levels are still elevated, which can give us a little bit of higher returns. It also allows us to play it safer and stay farther away from the market and not give up a lot of options premiums. So that's what I'm doing for this week. I'm currently at 370. I may inch that up later this week, but I am playing it very, very safe, and I'm sitting at about the 200-week moving average support level. So if the market crumbles, we still have a lot of downside protection before we participate in any losses. So this week, we have the Federal Reserve raising interest rates on Wednesday. The market has about a 62% probability that they will raise interest rates by 0.25%. And the remaining percentage, the market's betting that they will not raise interest rates at all. I think in this environment, they have to go walk the line with inflation continuing to creep up higher. If you take a look at the inflation numbers, we've seen that the goods inflation has come down, but the part that has been particularly sticky is the services inflation. And you can see that in some of the charts. You can see here in the blue, that's the services inflation, and that's something that the Federal Reserve is targeting. If they don't raise interest rates, and if they do something stupid like cut interest rates, then that will just allow inflation to keep spiraling higher. And one of the biggest problems that even caused this whole problem with the banking situation was that the value of the bonds on the banks' balance sheets had fallen. And you know what caused those bonds to go fall in value? Higher inflation. So if the Fed does a good job of bringing inflation down, that will help the value of the bonds on the balance sheets recover. And not raising interest rates and even cutting interest rates, I think, will run counter to that overall goal. But for some reason, they're not thinking about that. So I think they need to keep raising their interest rates. In this case, 0.25% seems reasonable. Let's just remember. So the Federal Reserve has two mandates. One is to keep inflation low, and two, keep employment at full levels, wherever that may be. So their mandate is not to go bail out these banks. And we've seen some bank failures, and over the weekend we've seen also some news that Credit Suisse is going to get taken over by UBS. Now, is that good for the banks? I think it is. That'll add some greater stability. But the price at which they're buying Credit Suisse is, I believe, 75% lower than the closing price. So I don't think that's good. I mean, what kind of signal does that send? If you're going to take over a company and you're willing to do it at 75% lower than the current price, then that gives me pause to buy these other banks. For these other troubled banks, what are they really worth? I don't know. And the market doesn't know either. That's why we're seeing so much volatility there. If you take a look at the most recent issue forbearance, look what they have. Buy the big banks. I personally don't agree with this idea. I mean, especially right now because things are still in free fall. One of the biggest mistakes that a trader can make is to buy something in free fall. The disciplined trader waits until the downtrend breaks. I mean, put some kind of moving average at least, or a trend line. For me, I would like to take a look at maybe a 21-day moving average, or maybe even a 50-day moving average. Generally, the longer term, the slower the moving average, the more significant it will be as a buy or a sell signal. Right now, it's still in free fall for these banks, and so I think this whole Barron's thing is a little bit premature. So, about interest rates, the big question is, where will interest rates stop? If you take a look at where interest rates should be, there was this economic rule called the Taylor rule, and it worked remarkably well. You can Google it and take a look at Wikipedia. But basically, the idea is that you want the level of interest rates to roughly be where the level of inflation is. And inflation is running at about an annualized rate of about 6%. And so I think that is probably a reasonable level where interest rates should be. Yes, inflation will eventually come down, but when that does, then you could lower interest rates. But as long as your interest rates are lower than your rate of inflation, that tends to allow inflation to keep spiraling out of control. And the Federal Reserve did a really good job back in the 90s of roughly, following this Taylor rule. We had Alan Greenspan use it, and when he did that, inflation was nice and tame, and we ended up having one of the best economic periods in history. Okay, so let's talk about the stock market. There's a lot of fear right now, and one of the gauges that I like to look at is this CNN fear and greed indicator. I love it. I like to look at it, and as you can see, whenever we've had excessive periods of fear or greed, that has tended to mark some good turning points for where the market has turned around. So excessive levels of fear have tended to roughly mark the bottoms for the market, and you can see the fear levels right now are roughly where we were back in October, and back in October was when the market bottomed. So that's one of the bullish cases that are in the favor of the market. The other thing is the Federal Reserve, in their panic to try to save the banking industry, they flooded the market with a lot of liquidity. If you take a look at the chart for the quantitative tightening, how they're shrinking their balance sheet, it looks like within about the course of a week, they were able to reverse about 4 months of quantitative tightening. And when you have all that money going into the market, it tends to prop up stock prices. So if you take a look at where bond yields are right now, they've plunged so much that it allows the value of stocks to go up a little bit more because bonds are now relatively less attractive. And if you take a look at where the fair value is based on my crude measure, that puts the S&P 500's fair value probably at about 395 up to about 410. So that is above current levels. And so that gives us a little bit more of a potentially bullish thesis over the short term. Also worth noting, if you take a look at the seasonality of the stock market, we typically fall in the first half of March and then recover in the second half of March, and that's where we are. But, it's a good idea to take this with a grain of salt because in a more normal environment, I would probably say, yes, this makes more sense, but we're also in an environment right now where banks are kind of falling apart left and right. So it could throw off the historical patterns. So for my portfolio this week, I have my puts at $370 It is way below the current market right now, and I think I could actually add a couple more layers, maybe 375, maybe 380, because that's where the support really is. But with the Federal Reserve coming up this week, I want to play it a little bit more cautiously. I know with the VIX being pretty elevated, one thing I've noticed with that is that support levels tend to become very brittle. So yes, the support is at 380, so that's the highest I'm willing to go. But with a high VIX level, if the market goes into a panic, it can blast right through that support level. And the safest place that I can see right now is probably where the 200-week moving average is, which is about 372. So that's why I'm sitting at 370 right now. I'm playing a chicken, and I may edge it up a little bit more if things start to look good over the course of the week. Okay, so for my parting thought, I wanted to share this little piece of information that I saw. I saw this graph that talked about some factors that affect our mortality. And here we always talk about trying to go build wealth and make money, and that part's all well and good. But ultimately, the real wealth comes with our personal relationships, and some of the studies actually seem to back that up. They've showed that your mortality rates are actually higher when you have isolated yourself socially, or you're feeling lonely, or you don't have any loved ones to be with you. So for my parting thought, hey, give somebody a call that you haven't talked to. Send them a text. Let them know that you've been thinking about them and you wanted to get in touch with them. Go hug somebody. So I hope that little tidbit improves your quality of life a little bit. We can never have too many great relationships. And I know as I've gotten older, it's harder and harder to make those meaningful relationships. So while you're still young, make those relationships and try to keep as many of them alive and healthy as possible. So that's all I've got for today. And as a reminder, if you haven't yet, please click like and subscribe. That'll allow you to get some notifications when I put out my next video. And as you know, I like to provide some analysis and some really helpful charts to help us navigate the market. So thank you so much for joining me, and I will see you next week.